Let me paint a picture that I think anyone who has ever paid attention to financial markets knows all too well. You open a brokerage app on your phone, right?
Oh, yeah, we've all been there.
Yeah, and you pull up this massively famous tech company, one that's, dominating the news, changing the world. And this is the kick, like, maybe they haven't turned a single dollar of actual profit in a decade.
Right, but you look at the screen and the market says this company is worth $1 trillion.
Exactly. $1 trillion. And then you look at a regional bank, a bank that has been quietly making $1 billion in solid, predictable profit every single year for the last century.
And the market says that bank is worth just a fraction of the tech giant.
Your immediate instinct as a rational human being is to ask, how can a company that makes zero profit be worth exponentially more than a company churning out cash? Are those the actual fundamental values of those companies?
It is the ultimate puzzle of corporate finance. And if you are listening to this right now as an MBA student preparing for a major exam on valuation, this disconnect is exactly what you are trying to understand.
Yeah, because we're moving past the introductory stuff today. This deep dive is our mission to completely demystify Unit 5, valuation of shares and bonds from your materials.
Right. Because knowing what an asset is intrinsically worth and critically, understanding the assumptions that drive that worth is the absolute prerequisite for intelligent corporate decision-making.
Whether you're modeling a leveraged buyout, managing a pension fund, or just, trying to survive your finance final, you cannot simply trust the prevailing market price.
No, you can't. You have to build the machine that calculates it. You have to understand how value is actually constructed, measured, and, frankly, sometimes manipulated.
And building that machine is what we're doing today. We aren't just going to hand you a list of complex algebraic formulas to memorize. We are going to look under the hood.
Exactly, because by the time we are done, the logic driving these models will be second nature to you. You won't have to panic memorize formulas because you will understand exactly why the variables interact the way they do.
Right. We want to explore the vulnerabilities of these financial models, the traps that catch even seasoned analysts. We'll start by untangling the very definition of value, because the word means completely different things to different people.
I mean, an accountant views value very differently than a hedge fund manager does.
Totally. Then we'll wrestle with the notoriously unpredictable beast of equity valuation, looking at how to measure companies that might never pay a dividend.
And finally, we'll transition into the highly structured, mathematically rigorous world of bond valuation.
Okay, let's unpack this. Let's start with that fundamental definition of value. Before we can even attempt to value a specific equity share or a corporate bond, we have to recognize that value isn't a single objective number sitting in a vault somewhere.
Right. It entirely depends on the lens you are looking through. We generally operate with 5 distinct flavors of value in corporate finance.
5 flavors. Okay, lay them out for us.
Well, you can think of these flavors as different rulers measuring the exact same object, but yielding completely different numbers based on what they are calibrated to measure. The first, and perhaps the most traditional, is book value.
Book value, right. So this is the accounting concept.
Exactly. It's firmly rooted in the historical data presented on a company's balance sheet. To find the book value of an equity share, you take the net worth of the firm.
Which is total assets minus external liabilities. Right?
Yes, and minus preference capital. You have to subtract that out. Yep. Then you divide that net worth by the number of outstanding equity shares.
Okay, so net worth divided by number of shares. But what's the vulnerability here for an analyst? Why isn't book value enough?
Because it's fundamentally backward-looking.
Yeah.
It relies on historical cost.
Let me use an analogy to see if I have this right for the listener. Imagine buying a used laptop. Book value is like looking at the original receipt from 3 years ago, subtracting a standard depreciation schedule, and saying, this is what it's worth today.
That's a perfect analogy. It completely ignores what the laptop can actually do right now, or what someone else is willing to pay for it.
Which is exactly why we have the second concept, market value.
Right. Market value is the prevailing price at which the asset can currently be sold in an open exchange, like the NSE or BSE.
So sticking with the laptop analogy, market value abandons the original receipt completely. It asks, what are identical 3-year-old laptops actually selling for on eBay today?
Yes. For financial assets, this is simply the prevailing price on a stock exchange. It's real time.
But there is a catch with market value, especially if you are evaluating a private company or, like, an illiquid asset.
Absolutely. If a security isn't actively listed and traded on an exchange, establishing a true market value becomes incredibly difficult. You don't have millions of buyers and sellers constantly voting on the price with their wallets.
Right, you lack that real-time price discovery.
Hmm.
Which leads us to the third concept, going concern value. And this one seems crucial for mergers and acquisitions.
Oh, it's arguably the most critical. Going concern value is the value of the business, not as a collection of static assets, but as a living, breathing, operating unit.
So expanding on our laptop analogy again. If I buy just the physical laptop, I'm paying market value. But going concern value is what happens if I buy that laptop with a profitable software business already installed on it.
Right. You're no longer buying hardware. You are buying an integrated cash-generating system.
I'm buying the whole operation.
Exactly. And if we connect this to the bigger picture for the exam, this brings a very important concept into play. Synergies.
Synergies, a classic MBA buzzword.
Yes, but it has real mathematical meaning here. If the going concern value of a firm is substantially higher than the mere sum of its individual parts' market values, that premium represents the synergies of the organization.
So it's the quantifiable magic of the whole being greater than its parts, the ability of those combined assets to generate future sales and profits.
Spot on. Now, on the flip side of that magic is our fourth flavor, which is a worst-case scenario metric, liquidation value.
The selling for parts value.
Unfortunately, yes. If a company fails, liquidation value is the net difference between what you can realistically get for selling off all the assets in a fire sale minus the total of all external liabilities you owe.
And the crucial takeaway here, something you really need to remember for the test, is that for equity shareholders, the liquidation value can frequently be absolute zero.
It's a harsh reality. Because of the absolute priority rule in bankruptcy court, debt holders are paid first.
So if the fire sale proceeds only cover the debt, the equity investors are wiped out entirely. They get nothing.
Nothing at all. Which brings us to the fifth and final concept, capitalized value. And this one will serve as the engine for almost everything else we discussed today.
Right. Capitalized value. What exactly is it?
It represents the sum of the present value of all expected future cash flows that an asset will generate, discounted back to today at a specific required rate of return.
So when we are dealing with financial assets, whether that is a stock, a bond, or a complex derivative, capitalized value is basically the gold standard.
It is. We are looking directly at the future economic benefits and adjusting them for the time value of money.
Okay, so if capitalized value is our North Star, our primary lens for discovering true worth, let's turn that lens onto what is arguably the most difficult asset class to evaluate: equity valuation.
The notoriously unpredictable beast of equity.
Right. Why is valuing an equity share so mathematically frustrating compared to, say, valuing a corporate loan or a piece of real estate?
Well, equity is a beast to model because it fundamentally lacks structure. When you value debt, there are contractual promises. With equity, you are dealing with three massive layers of uncertainty.
Let's break those down. Layer one.
First, equity shares have a residual ownership character.
We touched on this with liquidation value. They are standing at the very back of the line.
Yes, and that applies to operations, not just bankruptcy. Equity shareholders only have a claim on the residual profit, what is left over after the suppliers, the employees, the tax authorities, and the bondholders have all taken their cut.
And predicting that leftover sliver of profit is incredibly sensitive to macroeconomic shocks, right?
Extremely. This residual nature is exactly why investors demand an equity risk premium.
Let's lock that term down for the exam cheat sheet. The equity risk premium.
Yes. The equity risk premium is the extra rate of return that an investor absolutely requires to justify holding a risky equity share instead of a perfectly safe, risk-free instrument like a government treasury bond.
Makes sense. You wouldn't take on the uncertainty of standing at the back of the line unless you were compensated with a significantly higher potential payout.
Precisely. Now, the second layer of uncertainty is that equity shares have no maturity date.
They essentially last forever.
Right. Unlike a bond that expires in 10 years and returns your principal, an equity share theoretically lasts into infinity, or at least as long as the corporate entity survives. You have to forecast value over an indefinite time horizon.
That sounds impossible. But wait, there's a third layer of uncertainty, which I find to be the biggest hurdle: the nature of the cash flow itself.
Yes. Dividends on equity shares are neither guaranteed nor compulsory.
Right. Even if a company generates billions in that residual profit we just talked about, the board of directors can simply vote to pay zero dividends. The timing and the rate of the payout are completely unspecified.
So when you look at those three factors, residual claims, infinite lifespan, and discretionary payouts, it's very fair to ask how calculating a capitalized value is even possible without it devolving into wild speculation.
Exactly. I mean, if there are no contractual guarantees, no fixed timeline, and no mandatory payment amounts, how do analysts avoid just throwing darts at a board?
We avoid the dartboard by imposing structured frameworks that rely on explicit, justifiable assumptions. We build models.
Models that we know won't predict the future perfectly.
Right, but they give us a rigorous, logical way to process the uncertainty. We generally categorize these frameworks into two broad schools of thought: income-based approaches and market-based approaches.
So income-based uses discounted cash flow techniques, and market-based uses relative valuation.
You got it.
Let's carry into the income-based approaches first, specifically the dividend discount models, or DDM. Conceptually, this is the most direct application of capitalized value, right?
Yes. If you want to know what a stock is worth based on its income, we look at the actual tangible cash that is transferred directly into the investor's brokerage account, the dividend.
So the foundational theory here is that the intrinsic value of a stock today is just the sum of all its future dividend payments, discounted back to the present day.
That's the elegant theory of it, yes, to account for risk and time.
Let's make this actionable for the exam. Let's look at the different variations of this model, starting with the single period valuation model.
The most basic building block. This assumes a highly simplified scenario where you buy a stock, hold it for exactly 1 year to collect a single dividend, and then immediately sell it.
Okay, so the math. The value of the stock today is equal to the present value of the expected dividend 1 year from now, plus the present value of the expected selling price 1 year from now.
Exactly. Let's walk through an illustrative example. Imagine you are looking at HCL's share. You project they will pay a dividend of 3 rupees per share next year. And based on your industry analysis, you believe the stock will be trading at 20 rupees a share exactly 1 year from today.
Okay, so I have a 3 rupee dividend and a 20 rupee future price. Now I need to discount those future cash flows. I need my required rate of return.
Right. Let's say, based on the risk of this firm, your required return, often referred to as your cost of capital, is 12%.
Cost of capital. That's the hurdle rate, right?
Yes, the minimum return the market expects in order to justify deploying funds into this specific asset. So, taking your scenario, we need to discount both the 3 rupee dividend and the 20 rupee expected price back by 1 year at a 12% cost of capital.
So I divide the 3 rupee dividend by 1.1.
Correct?
And then I divide the 20 rupee future price by 1.1.
Yes. Add those two discounted present values together.
Let's see, 3 divided by 1.1 is about 2.68. And 20 divided by 1.1 is about 17.85. So adding them up gives me 20.53 rupees today.
Exactly. If the stock is currently trading in the market for 18 rupees, your model suggests it is undervalued.
That logic makes perfect sense. I like to think of the discount rate, that 12% cost of capital, like financial gravity.
Financial gravity, I like that.
Yeah, like cash flows that happen in the future are floating up there in time. The discount rate is the gravity that pulls them back down to the present day, shrinking their value because $1 next year is inherently worth less than $1 today.
That is a great way to visualize it for the exam. Now, the obvious limitation of this single period model is that equity doesn't mature in 1 year. Investors hold stocks for decades.
Which is why the framework simply expands into the multiple period valuation model. It's the exact same gravitational logic, just applied over a longer timeline.
Right. If you plan to hold the stock for 5 years, you have to individually project the dividend for year 1, year 2, all the way to year 5.
And apply compounding gravity, meaning year 2 is discounted twice, year 3 is discounted 3 times.
Yes. Finally, you estimate the selling price at the end of year 5 and discount that massive lump sum back as well.
But forecasting the exact dividend payout and the exact stock price 5 or 10 years down the road is incredibly fragile. I mean, the further out you guess, the more likely you are to be wrong.
Absolutely. This fragility is what gave rise to arguably the most famous dividend framework in finance, the constant growth model, better known as the Gordon growth model.
Named after Myron J. Gordon.
Yes. The Gordon model is a masterclass in using a powerful mathematical assumption to simplify a complex reality.
Because instead of trying to guess individual dividend payouts year by year into infinity, the model assumes that the company's dividend will grow at a constant, unvarying rate, which we denote as G, every single year forever.
And the resulting formula is deceptive because it looks so simple. The price today equals the dividend expected next year, divided by the required rate of return minus the growth rate.
Okay, let's walk through the mechanics of a typical exam scenario using this model. You're analyzing an established consumer goods company like XLTD. They just paid a current dividend of 12 rupees per share. Face value is 100, so that's a 12% dividend.
Right, and you estimate that their dividend will grow at a constant rate of 3% indefinitely. So G is 3%. Your required cost of capital, R, for this specific sector is 16%.
So G is 3, R is 16. The most common trap students fall into here is using the current dividend in the formula, isn't it?
It is the #1 mistake. The model specifically requires the expected dividend for next year, D1, not D0.
Okay, so you have to take that 12 rupee current dividend and grow it by your 3% growth rate for 1 year.
Exactly. 12 multiplied by 1.3 gives us an expected dividend next year of 12.36 rupees. That is your D1.
Now we apply the formula. We take that next year's dividend of 12.36 and divide it by our cost of capital minus our growth rate. So 16% minus 3% leaves us with 13% in the denominator.
Yes, 0.13.
So 12.36 divided by 0.13 gives us an intrinsic value of roughly 95.07 rupees a share.
That's the exact math you need for the exam.
But here's where it gets really interesting. As an MBA student, you need to understand where models break, not just how to plug numbers into them. The Gordon growth formula is incredibly, almost dangerously mathematically sensitive.
It is. The relationship between the required return, R, and the growth rate, G, in the denominator is the Achilles heel of the model.
Let's play this out. What happens if an over-optimistic analyst assumes a company is going to grow incredibly fast? Let's say the required return is 10%, and the analyst projects a perpetual growth rate of 9%.
The denominator is now just 1%, 0.01. The valuation absolutely skyrockets.
And if the analyst projects a growth rate of 10% matching the required return, the denominator becomes 0, and the mathematical value of the company explodes to infinity.
This is a vital constraint to understand for your exam. The DDM requires that R must be strictly greater than G, otherwise the math literally breaks.
But I want to push back on the economic reality of that constraint. We see tech startups growing their revenues and payouts by 30 or 40% a year, while their cost of capital might only be 15%. Doesn't the model fail to capture reality in those hyper-growth scenarios?
In a short-term snapshot, yes, a company can grow faster than its required return. But you must remember the core assumption of the Gordon model. This growth rate is assumed to last forever.
Forever.
Right. If you project a single company to grow at 20% perpetually, while the overall global economy grows at 3%, the mathematics dictate that eventually that single company will consume the entire global economy.
Which is a macroeconomic impossibility.
Exactly. Therefore, the perpetual G in this model must be a very modest number, typically anchored to long-term inflation or long-term GDP growth.
So the Gordon model works beautifully for a mature, stable utility company. But it completely falls apart if you try to value a hot new biotech company that just patented a revolutionary drug, because they are going to experience massive, explosive growth in the short term before eventually settling down.
To handle that, we have to bridge these concepts into the two-stage growth model.
The two-stage model. This is for companies bursting with temporary hypergrowth.
Yes. It acknowledges that a company's life cycle isn't uniform. It allows you to model an initial phase where the growth rate is extraordinarily high, followed by a second permanent phase where the company matures and the growth rate drops to a stable, sustainable level.
Let's map out how you actually execute this on exam. Let's use HUL as an example. Say they expect 20% growth for 6 years and then a normal 10% growth rate after that. Required return is 15%. How do we do this?
You approach it by breaking the timeline into two distinct valuation exercises and then summing the results. Step 1 is dealing with the high growth phase.
The 6 years of 20% growth.
Right. You have to individually project the actual dividend payout for year 1, year 2, all the way through year 6, compounding them at that high 20% rate.
Okay, so I calculate D1, D2, D3, D4, D5, D6.
Yes. Then you take each of those 6 future cash flows and individually discount them back to the present day using your 15% rate. That gives you the present value of the entire high growth period.
Okay, so the first 6 years are handled. But how do we value the rest of eternity starting in year 7 without doing an infinite number of calculations?
Because from year 7 onward, the growth rate is a stable 10%, which is less than our 15% required return. We can apply the standard Gordon growth model.
So we use a Gordon formula.
But And this is a critical structural point. We aren't applying it today. We are applying it at the end of year 6. You take the projected dividend for year 7, D7, and you divide it by the required return minus the stable growth rate.
So, using the Gordon formula at the end of year 6 gives you the terminal value of the company at that specific point in time. It encapsulates the entire infinite future of the firm from year 7 to infinity, packaged into one massive lump sum sitting at the end of year 6.
Exactly. And the final step, the one students frequently forget, is that you must take that massive terminal value from year 6 and discount it back to year 0, the present day, using your 15% rate.
Oh, because it's still sitting in year 6.
Right. The true intrinsic value of the stock today is the present value of the 6 hypergrowth dividends plus the present value of the infinite steady growth tail. If you do the math carefully, you'll arrive at a final answer of roughly 70.76 rupees.
It's conceptually dense, but when you break it down into valuing the sprint and then valuing the marathon, it becomes much more manageable.
Yes, separating the phases is key.
But there's a massive glaring blind spot in everything we have discussed so far regarding income-based models. The entire dividend discount framework requires the company to actually distribute cash to the shareholders.
That's the flaw.
Right. What happens if you are evaluating a company that is highly profitable but chooses not to pay a dividend, like a massive tech holding company that reinvests everything? According to the DDM, because the dividends are all 0, the intrinsic value of the company is 0, which is wrong.
It is a fatal flaw for analyzing growth-oriented or capital-intensive companies. If a firm is profitable but chooses to retain earnings, the dividend discount model is useless. That is why we must pivot our focus to free cash flow, or FCF.
Free cash flow.
The conceptual leap here is profound. We are shifting our valuation lens away from the cash that is actually distributed to investors and focusing entirely on the cash that is available for distribution, regardless of what management decides to do with it.
I think the best way to visualize free cash flow is to imagine owning a rapidly expanding bakery. At the end of the day, your bakery has generated a fantastic operating profit.
Okay, I'm picturing the bakery.
Now, the dividend is the literal slice of cake or envelope of cash you take out of the main register, drive home, and put it in your personal bank account. Free cash flow, however, is a much more rigorous metric. It is the actual profit sitting in that register after you have paid the taxes, after you have fixed the broken oven, which is your capital expenditure, and after you've bought tomorrow's flour, which is your net working capital.
That analogy perfectly tracks the actual mathematical formula you will need to execute on your exam to calculate free cash flow. Let's walk through the line items, because each one tells a story about the operations.
Let's do it.
You start at the top with EBIT earnings before interest and taxes. You multiply EBIT by 1 minus the corporate tax rate.
Why do we remove taxes right away? Because the government is a silent partner in every business. You cannot distribute cash to investors that legally belongs to the tax authority.
Precisely. That gives you net operating profit after tax. The next step is a major accounting adjustment. You add back depreciation and its intangible twin, amortization.
Let's unpack amortization, as that is a key term in corporate finance. While depreciation accounts for the wear and tear on physical assets like your bakery ovens, amortization is the systematic write-off of intangible assets over time.
Like if your bakery bought a valuable trademark.
Right. The accountants will slowly reduce its value on the balance sheet every year through amortization.
But why do we add both depreciation and amortization back into our cash flow calculation? Because they are accounting fictions designed to match expenses with revenues. They are non-cash charges.
You didn't actually write a physical check to anyone for depreciation this year. Since we are on a hunt for actual literal cash, we must add those non-cash deductions back to our profit line.
Okay, so our cash number just went up. But the next 2 steps bring it back down. The formula requires us to subtract capital expenditures, or CapEx.
Because fixing the oven requires real cash. That cash leaves the building. Therefore, it is no longer free to be distributed to shareholders.
And finally, we subtract the increase in net working capital. Back to the bakery, this is a silent cash killer for growing businesses.
Even if you are profitable on paper, if you have to tie up massive amounts of cash, buying inventory like stocking up on flour for new locations, your cash is trapped in the daily cycle of operations.
Yes, an increase in working capital acts as a sponge, absorbing cash away from the owners. So when you take operating profit, subtract taxes, add back non-cash charges, and subtract CapEx and working capital, the final number at the bottom of the page is your free cash flow.
Now, here's the massive conceptual twist that catches so many people off guard. If you project out those free cash flows for the next 10 years and you discount them back to the present day using your cost of capital, the final valuation number you arrive at is not the equity share price.
This is a vital distinction for the exam. When you discount operating free cash flows, you arrive at the enterprise value of the firm.
Enterprise value. What exactly is that?
Enterprise value is the total intrinsic value of the underlying core business operations, completely unencumbered by how the business is financed. Think of it as the price you would pay to buy the entire business outright, assuming it had absolutely zero debt and zero cash in the bank.
The house analogy works perfectly here. Let's say you do a full appraisal on a house, looking at the foundation, the roof, and you determine the property is worth $500,000. That is the enterprise value.
Right.
But if you want to know the equity value, the actual wealth belonging to the homeowner, you can't stop there. If there is a $400,000 mortgage on the house, the equity value is only $100,000.
Exactly. To bridge the gap from enterprise value to the actual share price that an equity investor cares about, you must adjust for the capital structure.
So how do we do that?
You take your calculated enterprise value, you add any excess cash sitting on the company's balance sheet because that cash belongs to the owners. Then, crucially, you subtract all outstanding debt because the bondholders and the banks must be paid before the shareholders see a dime.
And finally, you divide that remaining equity value by the total number of outstanding shares.
Yes. That gives you your intrinsic per share value based on free cash flow. This raises an important question. Why do institutional investors prefer this over the DDM?
Because it bypasses forecasting share repurchases or debt usage. It focuses purely on the cash generated by the firm's operations, unencumbered by financing choices.
Exactly. It's a much purer view of the economic engine.
Okay, that wraps up the intensely mathematical, spreadsheet-heavy world of income-based valuation. But let's be honest, DCF models happen in a spreadsheet vacuum. How do we value a stock based on what's happening in the real world?
We use Section 5, market-based approaches, specifically relative valuation. The premise here is that intrinsic value is simply what the market is willing to pay.
But wait, if the market is inefficient, aren't we just copying our neighbor's potentially wrong homework?
That's a fair challenge. Markets are inefficient, yes. But for an MBA exam, the key assumption of relative valuation is that the average market pricing of comparable assets is fundamentally correct, even if individual assets are mispriced. Because assets are comparable, pricing errors can be identified against the average.
Okay, so we use valuation multiples. The most popular indicator is the PE ratio, right? Price to earnings.
Yes. Stock price per share divided by earnings per share. It tells you how much the market is paying for $1 of current earnings.
And then there's the PB ratio, price to book. Stock price divided by book value.
Which is highly variable across industries based on growth potential and investment quality.
Okay, take a deep breath. We're officially leaving the assumption-heavy world of equity valuation. We are transitioning into the much more structured, mathematically rigid world of bond valuation. I like to call bonds the predictable sibling.
They are significantly more structured because they are built on contractual obligations. Bonds are long-term debt securities. Key components you need to know: periodic interest payments, which are called coupons, the face value, the maturity date, and the market interest rate, or discount rate, denoted as KDU.
So the valuation logic here is actually identical to what we did for equity. The fair value is simply the present value of the stream of cash flows, the coupons, plus the final principal.
Let's walk through an illustrative example. A bond with a par value of 2,000 rupees, maturity of 4 years, an annual coupon of 200 rupees, and a market interest rate, KD, of 8%.
Okay, so map out the cash flows. Year 1, 200. Year 2, 200. Year 3, 200. And year 4 is 200 plus the 2,000 principal, so 2,200.
Right, and you discount each of those back at the 8% market rate. When you calculate the present value of the interest stream and add it to the present value of the maturity amount, you'll see the core inverse relationship at play.
As the required market yield, KD, goes up, the present value of the bond goes down.
Exactly, it's a seesaw.
Now, here's a trick for the exam. Most bonds in practice don't pay annually. They pay semi-annually.
Half-yearly, yes. This changes the compounding frequency.
So here's the exam memorization trick. You don't need a whole new formula. For semi-annual bonds, simply double the time periods. So 4 years becomes 8 periods.
Step 2, have the I, the interest payment. So 200 becomes 100.
And step 3, have the KD, the discount rate. So 8% becomes 4%. Plug those adjusted numbers into the standard formula and you're golden.
It's a vital operational adjustment.
We know how to value a standard bond now, but exams love edge cases. Let's look at Section 7. Special cases in bond valuation. What if a bond pays no interest?
That is a zero coupon bond or a pure discount bond. It pays no coupons, one lump sum at maturity.
The formula is just the final maturity value divided by 1 plus KD to the power of n.
So face value, 100 rupees, maturity 8 years, discount rate 9%. Present value is 100 divided by 1.09 to the power of 8.
So what does this all mean? A zero coupon bond sounds like a terrible deal for the investor, waiting 8 years for a payout with no interest along the way. Why would someone buy it?
Because they are sold at a deep discount. You might buy that 100 rupee bond today for 50 rupees. The interest is the capital gain you make at the end, and crucially, it eliminates reinvestment risk. You don't have to worry about reinvesting intermediate coupons at lower rates.
Ah, that makes sense. Another edge case. Perpetual bonds. No maturity date. An infinite stream of interest.
The formula simplifies to pure elegance. Interest divided by KA, IH over KD.
Like the Gordon growth model with zero growth. So 200 rupees annual interest into perpetuity, market yield 15%. Present value is 200 divided by 0.15, which is 333.33 rupees.
Exactly. Now, to ensure maximum retention and exam readiness, let's synthesize the material by running through a rapid-fire glossary of terms that commonly appear as short answer questions.
Section 8. Key terms rapid fire. Let's do it. First up, amortization.
The liquidation of debt through installments or the systematic write-off of intangible assets over time.
Next, capitalization rate.
The ratio between net operating income and capital cost or market value. It's essentially the inverse philosophy of a PE ratio used heavily in real estate.
Convertible security.
Bonds or preferred shares that can become equity. They grant the investor the right to convert their debt instrument into ordinary equity shares.
Cost of capital.
The expected rate of return required by the market. The hurdle rate.
Current yield. And this is a trap.
Yes. Annual income divided by current price, not face value. If you pay a premium for a bond, your current yield is lower than the coupon rate.
Equity risk premium.
The extra return required for holding risky equity over risk-free instruments because equity holders are last in line.
Term structure of interest rate.
Also known as the yield curve, it's the graphical relationship between interest rates and their different maturities, usually slopes upward.
And finally, the big one, yield to maturity, or YTM.
The discount rate that makes the present value of future cash flows equal to the bond's current price. What's fascinating here is that YTM is the absolute most critical term. It's the great equalizer.
Right, because it allows you to compare a 4-year high coupon bond directly with an 8-year zero coupon bond on a completely level playing field.
Exactly. It synthesizes all the structural differences into a single comparable annualized rate.
Well, whether you're looking at unpredictable dividends, meticulously calculated free cash flows, or rock-solid bond coupons, valuation always comes down to the same core principle: identifying expected future benefits and discounting them back to today based on the risk involved.
That is the heartbeat of corporate finance.
So as you close your books and get ready for this exam, we want to leave you with a final provocative thought to ponder for your studies.
Think about a company that suddenly decides to slash its dividend to zero to fund massive capital expenditures. According to the dividend discount model, the stock's value should plummet.
Because D1 is now zero.
Right. But according to the free cash flow model, if those investments generate high returns, the enterprise value will skyrocket. The models give you completely opposite answers. As an MBA student, which model do you trust more to find the true going concern value of that business? Good luck on the exam.